For those who don't know, he will provide the background on what percent is all about, but it's an asset class that I think all folks should have exposure to. And I've been very, very impressed by what the team has built over the years. I actually had the good fortune of meeting the percent team, geez, 6 or 7 years ago at this point, which is pretty wild. And they've come such a long way since, as many in the alts industry have. So, really excited to be able to share this company with you, learn more about kind of commercial credit, what it means to have in your portfolio, how percent works. We love doing these educational sponsored webinars to really teach you about these other alt opportunities that are available to you to invest in. So, with that, I'm going to kick it over to Prath. Prath, thank you for joining us. And for those who don't know you, tell us a little bit about yourself and how you guys came to found Percent.
Sure, absolutely. Chris, great to be here. Thanks for having us. Really excited for today's conversation. So by way of background, before I kind of started Percent with Nelson Chu back in 2018, I worked on the sell side. So for about 10 years, I worked in the debt capital market side of the business at a couple different banks, but most of that time at UBS. So for those that don't know what debt capital markets does at an investment bank, it's effectively advising CFOs and public companies on accessing the bond market. So anytime that a company like Pepsi wanted to raise a couple $1 billion of debt capital, they would call up all of their relationship banks, and we would be there to support them in that endeavor. And that was primarily sold to institutional investors. I was firmly in the fixed income market for the better part of a decade. And then I was a director at UBS in 2018, and didn't know if I wanted to be a career bond banker for the rest of my life, to be quite frank. I had just gotten married at the time, didn't have any kids, and figured it was either now or never in terms of rolling the dice and taking a chance at something new. So that's when I met Nelson on AngelList of all places. He actually had a posting for like a director of risk type of person for a new idea that he had around building a private credit marketplace. And he came into that idea through his relationships with a lot of family offices that were looking for this type of exposure at the time. They were all looking for kind of asset-based private credit, short duration deals that rivaled, the likes of what Yield Street and Fundrise and others had to offer, but really wanted to build a better mousetrap. And so when I heard about his idea, I decided to take the plunge, much to my wife's dismay at the time, and I decided to join him on this journey. So, the past 7 years have been a wonderful experience, building this private credit marketplace in a way that can scale, in a way that takes advantage of all of the kind of institutional aspects that I think are taken for granted, and really leveraging them to build something that can really drive a lot of capital flow in the middle market and lower middle market space, which is where we operate today. So happy to dive into all of that, but that's a
Yeah,
quick
there's
synopsis.
certainly plenty to dive in on there. So just to get started, can you explain for folks who don't know what is unique about the private credit asset class? What are some of the benefits and maybe even some of the challenges involved with private credit?
Mhm. Yeah, so I think historically speaking, just to kind of take a quick history lesson around where private credit came from, it's been around forever, right? So I think private loans being offered to private individuals or small businesses is something that's been around since the dawn of time. I'd say that it really became an investable asset class post the global financial crisis. It started becoming something that a lot of non-bank lenders decided to focus on and really take advantage of the gaps that the banking sector was creating as a result of just increased regulations around where they can lend, right? So, there's still a growing number of consumers and small businesses that needed credit. And so over the last, call it 15 years or so, you've seen this explosion of non-bank lenders and non-bank lending strategies, whether they are like fintech originators all the way up to large global private credit funds that are really filling this space and offering really interesting risk-adjusted returns for investors that have, all the hallmarks of a well-secured, well-structured loan, but with interest rates being offered that are above kind of what the benchmark rates offer, out there, whether you're looking at investment grade debt, high yield debt, or certainly treasury bonds and so forth. So it's a very interesting kind of space within the alternatives umbrella that has characteristics that are similar to those of fixed income, but also has this, call it scarcity premium. It has this illiquidity premium associated with it. It has all of these different factors that add up to an interesting risk-adjusted return that, we would argue, deserves a home in everyone's portfolio to some extent.
Yeah, absolutely. So when you think about kind of a typical profile, and I'm sure you kind of have a blend, but the type of business that's coming to you, why do they need the capital? How large are they? Are there certain industries? Would love to just know a little bit more about that kind of persona of the companies you're lending to.
Yeah, yeah, absolutely. So here at Percent, we've actually really carved out a niche for ourselves in terms of where we decided to play within this sector. So there are any number of non-bank lenders that are out there that are specifically lending to small businesses and consumers and kind of up the value chain, if you will, in terms of company size and sector. What we decided to focus on in the very beginning and still what we do today is really lender finance. So that means that we are lending to other lenders.
Hmm.
So think about, these non-bank lenders that exist that are, very data-driven, that have, diversified portfolios of loans that they've originated to underlying small businesses or consumers. So we'll go in and analyze how well they've been able to put that money out, look at their historical track record in terms of how well those loans have performed, and structure a credit facility where we are getting a certain level of cushion or protection against future defaults and losses that underlying lender has experienced in the past. So therefore, as an investor that's coming into any of the deals that are on our platform, you're effectively getting diversified underlying loan exposure and diversified underlying cash flows that are supporting the interest rate and the coupon that you're earning, and with a lot of kind of cushion built in the event that those underlying loans don't perform as expected.
Hmm.
So doing it this way allows us to really have the ability for investors to build extremely diversified portfolios. So it's not just at, the deal level. If you think about it, every deal has, perhaps hundreds, if not thousands of underlying loans and underlying obligors that are supporting, the note and the, kind of the investment that's in their portfolio.
That's really interesting. And I'm curious, so, most, if you're into kind of equity crowdfunding deals, right, and looking at deals on our platform, so it's an individual deal. Obviously, there's a lot of risk for all the reasons of it being private equity, but
Mhm.
they're individual deals, and those deals get funded one by one, and they have to get filled out one by one. In your world, are you all kind of investing money off of the balance sheet and then selling basically to your investors the opportunity to get in, and then that kind of refills your balance sheet? That way you could fund immediately. How does that work?
A great question. So we actually syndicate every deal on the platform on a best
Hmm.
efforts basis. So we don't actually take any balance sheet risk ourselves. We have a registered broker dealer that's a 250 net cap broker dealer. So effectively, we run a brokerage platform. So investors are depositing money on our into their brokerage accounts, into their percent accounts, and then they're able to look at all the outstanding deals that are available, and those outstanding deals are typically, syndicated over the course of 2 weeks, and an order book effectively builds. So as an investor, you're placing an order into that deal. You say, hey, I'm interested for anywhere between $100,000 and $50,000, as long as this deal closes at 15% coupons or higher. And
Hmm.
then at the end of the syndication period, you get an allocation. Now, it's not an allocation from our balance sheet. It's actually a brand new note that is being issued at that time of closing. And the proceeds net of our fees are going to the underlying lender or borrower, to ultimately allow them to originate more loans. So we're doing all the work of, analyzing the collateral, ensuring that there's sufficient coverage for every note that's being offered on the platform, but it's actually not our balance sheet. It's all being done on a
Hmm.
best efforts basis, and we have great institutional investor relationships that are bringing more certainty to the table at the closing table. So that allows us to do larger deals for call it more established borrowers that require that level of execution certainty. So that's something that we've been focusing on over the last call it 12 to 24 months. So today our deal sizes are a lot larger. We're talking 5 to 10 million
Hmm.
typically these days versus the sub 1 million when we first started chatting 6 years ago. And that's all based on the depth of our investor base. We have 50 to 60,000 investors that are signed up on the platform. And we have higher confidence to be able to close it at the closing table when, at the end of the syndication period. So it doesn't require our balance sheet at the end of the day.
That makes a lot of sense. In terms of the lenders that you're basically providing funds to then lend out to businesses,
Mhm.
um, why do they choose percent? Is there a lower fee or a lower cost of capital? Traditionally crowdfunding actually can be a more expensive form of capital in a way, right?
Yeah.
Because you have to market the deal and so on. So why do they like working with you all?
Ooh, so another great question. So in terms of our competitive advantage here at Percent versus another lender that may be able to structure something similar for these types of borrowers, we are able to start earlier. So for most of these non-bank lenders, they won't get a term sheet from a larger private credit fund until they have perhaps a 10, 25, maybe even $50 million portfolio of underlying loans that they've originated. We're happy to start earlier. And it's mostly because of the way that we underwrite. We underwrite to the quality of the data and seeing at least a few turns of their book over time. And that's enough to kind of allow us to get comfortable to start very conservatively and then look to, scale that up in terms of, offering higher advance rates against the underlying collateral, offering longer terms against, the underlying portfolio. So we're happy to start earlier. That's probably the biggest advantage that we have. So a lot of the lenders that, come onto the Percent platform, they're probably, call it at least 1 year, if not 2 years or more, have been doing this in terms of years in business for that specific originating company or non-bank lender that they have. Typically speaking, these management teams have historical track record and experience elsewhere doing it somewhere else. And now they've started up a new, non-bank lending venture, and they're showcasing that they can perform well, and we have active discussions with folks that are in our pipeline. So we're only bringing lenders and originators to market that have showcased that they are able to lend responsibly, have high quality and performing portfolios, and have the ability to scale. So all of that time and effort is worth it for us, but it's not worth it for, let's say, a private credit fund that has $1 billion that they need to deploy. Like, they're not going to be writing $1 to $5 million loans. They want to be able to put 25, 50 million out, because to them it's the same amount of time to underwrite a $50 million deal as it is to underwrite a $500,000 deal. For us, we have been able to really meet originators where they need us to be in order to make it worth their time and our time to do smaller deals.
I love that. One of the complaints, if you look at the kind of the late stage secondary space, right,
Mhm.
is the fee structures where
Yeah.
there could be a fee on an SPV and then you're getting into an SPV of an SPV and then there's a broker fee. By the time you add it all up, it's 20, 30%, right? It's like, what am I
Mhm.
even getting? And oftentimes it's going to already be overpriced anyway.
Right.
So when you think about your fee structure, obviously they need to get the cost of capital where they need it so they can
Mhm.
make money. You need to make money. What do those fees look like, and how do you make sure you're still providing good return to investors?
Yeah, the great aspect of operating this end of the market is that there isn't that much competition.
Hmm.
And when you have an uncompetitive market, you have pricing leverage. So as long as we are at least what other private credit funds offer, then our all-in kind of cost structure to these originators is still very attractive. So and especially when we're the only game in town at sub $5 million credit facilities, they're happy to kind of view this as the cost of getting something going, and with the intent to probably try to refinance us out down the road if we're not able
Hmm.
to deliver them cheaper cost of capital. So our fee structure is, we charge, a couple points up front in terms of a placement fee through our broker dealer to actually place the Reg D security with investors. And then we charge a servicing fee on the coupon that's being offered to investors to, continue to manage the loan that's outstanding, all the cash flow servicing involved. If there are any workouts related to deals, we're the ones that kind of bear the brunt and the effort and the cost in kind of working those loans out. So it does cover our overhead for every individual loan. So kind of that upfront and ongoing fee structure is what we charge. But all in, we're talking about a couple points. And a couple points seems like a lot, but this is private credit. So we're talking about, kind of at least mid-teens type of returns is what, investors can come to expect with these types of deals. So all-in cost to these underlying lenders is maybe in the mid to high teens. So investors are getting mid
Mm,
to low teens. So there's still plenty of room to maneuver here. And over time, as the programs get larger, it does attract more institutional capital, and the institutions want to be able to put in, seven-figure checks into individual deals. And at that point, they're not looking for, mid or high teens returns. They're looking for double-digit returns, right? 12, 13%. So our fee structure doesn't get compressed as the deals get larger. It's really that the interest rates get lower because we're able to attract larger check sizes and larger investors into these deals that don't need, 15, 16, 17%.
yeah, that I really like that. I think that's very interesting and creates a fairly low cost of capital for your investors.
Hmm.
Um, in terms of how disbursements work, folks getting paid back, how long the typical turnover is on, hey, I invested in this portfolio. Am I getting paid back in 2 years, 5 years, 10 years?
Yeah.
What does that look like?
So the other great benefit of our platform is that we've set up these short duration notes.
Hmm.
So it's analogous to a term ABS deal in the institutional market, where you have a interest only period that's in the front end, and then you have an amortization period on the tail end. And so that allows the underlying lender, the borrower here, to originate loans during the interest only period. So continuing to
Hmm.
recycle capital if it's kind of coming back from underlying loans. And then if they choose not to refinance the deal for whatever reason, then it goes into an amortization, which then pays off investors. So, irrespective of the term, and the typical terms are anywhere between 9 months to 24 months in terms of legal final. Typically speaking, the borrowers here, the lenders come back anywhere between months 3 and 12, depending on the legal final, to come back and refinance the deal. So as an investor, you're getting inherent liquidity within a year. I'd say the vast majority of the time. And so you can elect to roll over, your principal and interest upon the next refinancing, or you can choose to take out all or some of it. So it's really up to you, and you can kind of continue to keep money out to work as a result. But the lenders like this as well because they want to continuously try to raise more capital, refinance it, on their terms. And so there is no prepayment penalty, right? There is no kind of typically there's no kind of call protection. So that's kind of the give-get model. Investors are getting short-term kind of, inherent liquidity, and borrowers are able to, refinance us at will and potentially even leave the platform altogether. Although, we've had relationships with originators on our platform that have been around for 5, 6, almost 7 years now.
Hmm.
And we just continue to kind of drive their cost of capital lower by introducing more institutional investors. So the risk of churn isn't as high anymore because we can solve for larger deal sizes today. So,
Well,
so the whole like, they may repay you and go away forever is not as prevalent anymore.
I feel like, no, that's great. I was kind of curious, like how many are saying, all right, well, now we're going to move on to JP Morgan or some major lender and leave you behind in the dust, right?
Yeah. I can
But it
assure you
sounds
it's
like,
not JP Morgan as their next step.
yeah, yeah, fair enough. Um, So when we think about, you talk about churn on kind of the lender side.
Mhm.
One mark of quality is that people continuously just reinvest the dollars because they go, hey, you're doing a great job. I want to keep my money parked here and let it grow.
Mhm.
As you think about your business, you guys have deployed, I think, a little over $1 billion into deals. How much of that is coming from kind of like new growth versus people just coming back and the dollars are getting larger because they're staying on the platform and those dollars are growing?
Mhm. So I'd say it is certainly a lot of repeat customers. Um, our ability to prove that this works is done in a very short amount of time. So if an investor signs up for as little as $500 in their first deal, because that's kind of the investment minimum for some of the 9 month or shorter deals, because it's 9 months or shorter, it's an unlimited number of investors, so we don't really care what the minimum is, and the platform can
Sure.
manage a million investors or 10 investors, it doesn't matter. So if they come in for $500 on an initial deal just to kind of test drive the platform, they'll see, an interest payment a month later, right? And then they see it
Hmm.
again a month after that. So, what you typically see in terms of the investor journey is that, folks will test it out for a couple months. They'll see that, hey, this isn't a scam. This is, interest is coming back and I can redeploy this and it's kind of everything that they say that they're going to do. And then they tend to kind of build up their portfolios over the next, call it, year or two. And then, at that point, it's really education. It's, how much of
Mm,
your holistic portfolio should percent make up of? We never say that, you should invest all your money in percent. We are an arrow in your quiver of alternatives, if you will. So there's an appropriate and responsible amount that you should be deploying into private credit, and we're trying to get as much of that market share as possible. So over time, I'd say it's a lot of repeat business. We've had investors churn because we have had defaults in the past that, led to some investor losses. I will be upfront with that. Granted, a lot of those deals were not in the lender finance category. We had done venture debt offerings. We had done a couple corporate type of loans for, kind of unprofitable companies. And, a few of those just didn't pan out. Granted, the interest rates were, 20 to 25% in some of those
right.
cases. So, the risk was certainly there and the disclosures were there and everyone understood kind of what they were getting themselves into. But it rubs folks the wrong way, right? When you lose
Sure.
money. So granted, I'd say the majority of our churn has happened because of, these kind of corporate venture debt, kind of one-off defaults that we've had. Our default rate is very low. It's, call it about 3% overall, but like about 1% or around there for asset-based. And even in the asset-based category, the recovery rates are very high. So it's not like you
Mm,
lose your shirt with an asset-based default. It's just that you may get paid a little bit, behind schedule, if you will. So, and compare that with 15% average returns, you're still pretty well off on even kind of a loss adjusted basis. So all that being said, I think it's a good healthy mix of existing investors continuing to build their portfolios, new investors that we find through a variety of channels, kind of testing us out, kicking the tires, and deciding to do a lot more as time goes on.
it's tax season, so we'll talk about it. Are you getting a 1099 interest form every year? Is there a way, if you're rolling it over, that you don't have to pay the taxes on the interest in that year? And can you use an IRA to kind of push off the tax thing for many years?
Yes. So it's a 1089 every single year. And what we'll do is we'll actually consolidate all of your percent note investments. So it'll
Nice.
just be one 1089 at the end of the year rather than, 50 if you ended up investing in 50 deals. So that's a benefit that we afford. And if any of those deals happen to be international though, then you will get separate 1089s for those international
Mm.
deals. So just something to keep in mind. But if it's all US, then it's just one 1089. Um, and then, in terms of, ongoing, sorry, what was the second part of your question? It was just,
Like, can you use an IRA to fund it as well?
yes, yes. So on the
Nice.
IRA side, what we have is actually great integrations and partnerships with a few different, IRA custodians out there. Rocket Dollar, Alto IRA, and we have relationships with a few others that, frankly, as investors come to us and they say, "Hey, we use this custodian," we typically say, "Okay, let's reach out to them and see if we can kind of get something going here." And 9 times out of 10, we successfully create some type of channel with them. So I don't think there's one that we've come across that we haven't, at least explored, if not, onboarded. So we're very, keen to support qualified accounts to invest on the platform.
Well, I will say, I remember in the early days of our industry, I was invested on one real estate platform, and I won't say the name, but yeah, I think I got about 27 K1s, and I was like, if this is how it's going to be, I don't know if I can do that. And they're
Yeah,
all like 6 cents, 7 cents, 5 cents. I was like, do I really need to put all these in?
yeah,
Um,
that's it.
so
That's
consolidated 1099, as silly a thing as it sounds, is actually deeply value and carries a lot of value come tax season. Um, so let's talk about risk a little bit in this asset class. Understanding general default rate. I know you hit on yours. It sounds like it's a very low default rate.
Mhm.
But what does it tend to look like? How do
Mhm.
folks think about risk and how do they model risk in this category?
Yeah. So the conversation around default rates in private credit is an interesting one because it is very much manager reported. And there's a few publications out there. One in particular is the ProScour Private Credit Default Index. It's the law firm that puts out basically a survey and is able to generate kind of a quarterly default index. And so that is segmented by company size. So they'll do like sub $25 million EBITDA, 25 to something higher, and then kind of the larger end. And so we constantly kind of comp ourselves to obviously the smaller end of that index, the sub $25 million category. And we continuously have punched above our weight in that respect, especially in the asset-based category. So, but the, you know, but the the one disclosure around that is that ultimately they're getting their data from managers, and these are private loans, right? And for better or for worse, here in the percent market, we are very strict when it comes to payment defaults. And if a deal has a 9-month term, and if they don't make that payment within a 5-day grace period of when that maturity date is, or if they don't make an interest payment within the 5 business day grace period during the course of that loan, we have no choice but to put it into workout and default status and then figure out what's going on. Whereas, for credit funds, they have the luxury of being able to restructure and renegotiate and potentially put in, PIK type structures where maybe they don't even get interest income for several months, quarters, or even years in some instances. And you almost have these kind of ghost-like positions on their portfolio that all of a sudden they mark down, and then all of a sudden you kind of see the underperformance in a single period when they report. So it's a little bit of a chicken and egg game when it comes to, whether or not the default indexes out there that are being published are accurate or not. You just don't know what the quality of the underlying data is, and how well you can kind of, measure. But here on Percent, we're as, straightforward and honest as we can be in that, hey, this was the payment date, you didn't make the payment, so we're going to mark it as default. And even with that strict stance, we're still kind of hovering right at or below kind of the reported figures out there.
Nice. So you talked a lot about, we heard the word private a lot, right? And so these
Mhm.
are not public bonds or anything like that. Obviously, the public markets recently, right, have seen a ton of volatility for a multitude of reasons. Um, Talk to me about, is private debt, or do you see that it's uncorrelated from public equity markets? Is there still correlation? Um, and during periods like this, is this an asset class where you could find less volatility?
Yeah, I think the notion of private credit, being a less volatile asset class is certainly evident, irrespective of whether or not managers are accurately valuing the underlying loans or not, and taking advantage of the fact that they don't have to mark to market, right? So if you don't have to, then you're kind of smoothing out that volatility over time. But I'd say irrespective of that, a private loan to a middle market company or lower or upper middle market company, it has really no bearing on kind of what equity markets are doing or kind of investor sentiment. It's very much more firm specific at the end of the day. So as long as the quality of the underwriting, the quality of the underlying cash flows that you're underwriting to are all evident, it should perform as expected, and it has no weight against what's going on in broader markets. So from that perspective, I'd say it is very much uncorrelated. Now, it also depends on the duration of the loans, right? If they're shorter, then they get repriced more often, and in a competitive market, those loans may be repriced based on prevailing rates because investors have optionality and they can pick and choose where they want to deploy capital. So in a declining rate environment, you'll see a lagging effect in private credit. You'll see as loans come up for maturity, they need to get refinanced. Well, guess what? They're going to be offered at lower rates, and you're subject to that reinvestment risk. Same thing in a rising rate environment. So the investors benefit in that case. So from that angle, like, yes, it's slightly correlated to prevailing rates overall. But as far as, equity markets are concerned, I'd say it's more or less night and day.
I think one of the challenges of traditional private equity, traditional um, private debt, is that they don't take a very data-driven approach. You obviously all are a platform. You look at a lot of potential lenders. You've seen a lot of data come through your system. Um, what items, within the data are you utilizing, do you think, to maybe better inform and create better models for underwriting potential deals?
Mhm. So the precursor for any of the lenders to be able to raise capital on Percent is to be able to provide a very accurate and detailed loan tape and kind of payment ledger, if you will. So that is only able to be done if the underlying lender uses some type of loan management system or something that they've either built in-house, which is something that we see more of, especially as they lend to kind of very unique categories where an out of the box loan management system that exists out there that were built primarily for mortgages or other kind of, very mainstream asset classes just don't fit. So, irrespective of whether they, use something off the shelf or they build something very custom internally, that is the basis, right? If they don't have that, then we can't get the data that we need to be able to underwrite that deal. So the quality of the data matters. The granularity of it matters. We want to be able to see, all the demographical information that would be interesting for any underwriter to know. So it's not just whether or not a loan has been repaying on time, but have there been, any late payments, right? Where are the borrowers located? If there's collateral attached to those loans, where were those valued at, and kind of what's the loan to value on the loan that we're looking at to the underlying assets. So all of that data needs to be presented in a very, kind of granular way, and some lenders can do it, some can't, and that is kind of a line in the sand that we've drawn to differentiate ourselves and kind of our approach and the types of lenders that we want to work with. And frankly, I think it's becoming more table stakes than not as a lender out there, as a non-bank lender that wants to compete in this space, to be able to provide that type of data. Because if you're not, you're never going to be able to get institutional capital down the road anyway. So this is our way of kind of making sure that, hey, you have what it takes to do this with us today, but you are also forward thinking enough to know that you wanted to have very good hygiene when it comes to collecting underlying data and providing kind of that transparency to us, because the market's going to demand it as you get larger and as you look to raise more capital down the road.
Yeah, that makes a lot of sense. Something you mentioned in there is, within private credit, there can be a lot of unique structures. And that's something I've found really fascinating over the years. You could lend against accounts receivables, you could lend against property, you could lend against, invoice factoring, right? There's all sorts of different types of lenders out there. Are there certain lending groups or types of loans that you're comfortable with and others that you're not? And what do they look like?
Mhm. We gravitate more towards the shorter duration loans than longer duration, just because we can see more turns and just more vintages, and be able to analyze that and get more comfort in a shorter amount of time. So going back to our thesis as to what I was saying before, like we want to start earlier. But if you're out there originating 10-year mortgages, then we're not going to see any of that capital or principal come back outside of prepayments. And we may need to see a whole like market cycle for that to happen, right? So we tend to kind of, look at lenders that have created interesting loan product that is no more than like maybe, 12, 18, 24 months in duration. A lot of it's actually shorter than a year. And that also has the effect of compounding as well. They're able to recycle that capital, put it out, and be able to earn a higher annualized rate, which then supports the higher interest rates that we're offering to, investors on the Percent platform. So a lot of folks say, how is it that, this borrower can sustain a 15, 16, 17% rate in perpetuity? And we say, well, because they're earning 30% from the underlying assets.
Hmm.
And they're only able to earn 30% if they're turning that capital over at least once, if not twice, thrice, or more, because the underlying receivable itself, those cash flows are so short duration.
Hmm.
And they're also, attached with higher interest rates as well. So we try to gravitate towards that, and we try to look for as many lenders out there that are catering to that. And what we're seeing more of these days as well are embedded finance plays, embedded lending companies. So, the analogy I like to use is, if you go out and buy a car, say you buy a Toyota, right? And you want to get a lease or you want to get, financing terms, Toyota Motor Credit Corporation's right there. They're the ones that are kind of underwriting that loan for you. And so it's a captive finance company to, an automobile manufacturer. So the same thing is kind of happening here, but on a micro and massive scale. There's a whole host of kind of companies that are creating widgets or providing services, whatever it might be, but they're getting all of this interesting kind of underlying customer data that could be used for credit decisioning. And they're embedding lending products within, their customer journey and their customer experience. So point of sale financing, if you think of like, a firm or Klarna, right? Like offering that at the point of like checkout, like that type of stuff is really interesting, but there's also other B2B use cases as well for it as well. There's a lender on our platform that, provides factor receivables, but it's embedded within accounting software. So
Hmm.
as a, kind of treasurer or accounting, accounts receivable person, you can kind of elect to say, hey, I'll pay this, a little bit further out because I'm happy to, pay the extra fee because I don't want to pay this out in the next 30 days. So being able to do that right there and having those terms get, generated, on the spot within a second and being able to say yay or nay and then having that, funded is really interesting. So that's the type
Yeah,
of stuff that I think is really moving the needle and we'll see more of going forward.
I love that. We have a whole bunch of questions coming in, and please, anyone who's on the call, feel free to drop them into the Q&A, and we'll try and get to as many of them as possible. So I'm going to just start reading them off and going through.
Cool.
This comes from one attendee. Is there any risk if something were to happen to Percent as a lending platform? Or are the deals all done direct with the lenders such that if Percent disappeared, what would happen to our investment?
Mhm. Yeah, absolutely. So percent at the parent level, we actually have a backup servicer in place. So the backup servicer is a group called Citadel SPV. You can look them up online, but they offer these types of services to other organizations, mostly other kind of private credit funds, but a whole host of different kind of structured credit facilities out there where they can step in and basically service the notes that are outstanding. So, our primary function after a deal is issued is, managing the cash flows coming in from the underlying lender and then paying that out to the investors through our Series LLC vehicle, which is set up in Delaware. And we have, a dedicated SPV for every offering on the platform. So it's kind of a one-to-one basis and nothing is commingled on that end. So, Citadel is our, accountants at the SPV level. They're also the independent directors of all the SPVs. So they are best positioned to basically step in the event that we, can't service those cash flows for whatever reason if Percent can't do it. Um, so that's the primary risk if Percent were to, kind of go away one day, let's just say. Percent Securities as a broker dealer is, kind of on the front end offering the deal to begin with all the disclosures. So granted, if we weren't around, those deals may not come up for refinancing because there's maybe no one to refinance them or help the borrowers refinance. So everything will probably just get kind of paid out over time, but that would be Citadel's role.
The next question here is who sets the coupon rates, Percent or the issuer?
So the novel part of the Percent platform is that the market sets the rate.
Hmm.
So when a deal is offered in syndication on Percent, you'll see a range of yields being offered. So let's just say it's 14 to 16% with 50 basis point intervals. So as an investor, you can go to the deal page, you can indicate an order and say, hey, I'm interested for, $100,000 as long as this deal closes at 15% or higher.
Hmm.
And you say, hey, and at the end of the syndication period, if you're planning to kind of cut me out of this deal, I don't want anything less than maybe $25,000. So that's kind of your order instruction for the deal. Now you'll see a live order book on the platform as an investor. The borrower also sees the live order book. We as the manager also see the live order book. So we'll see all the, kind of allocations come in, the allocation requests, and then you typically, we'll have like an oversubscription of the deal. And at that point in time, at the end of the syndication period, the borrower basically chooses, do I want to maximize proceeds and take this, the highest rate, because that's effectively what ends up happening. There's more bids at the highest end than the lowest end. Um, or do I want to kind of take the tightest deal that's offered to me with the lowest
Hmm.
amount of proceeds or somewhere in between. So it's really up to the borrower's choice. But the market is presenting the borrower the available offers at the end of the syndication period.
That's actually really interesting. If you can share, and it's okay if you can't, but is there kind of a band that you see? Like, do lenders tend to go for the most, the least at the tightest, or they kind of end up all in the middle?
I'd say typically speaking, they gravitate towards the wider end because they're all, a lot of them are in growth mode and they figure the marginal cost of, taking $500,000 more for 50 basis point higher is negligible because they're going to be able to put it to work, very quickly. So for them, it's an exercise of kind of where the market is, but they'll probably take, as much as they can get. But it's also limited by their collateral, right?
Hmm.
So at the end of the syndication period, if it ends up being really well oversubscribed, we still limit them based on the amount of collateral that they have and the amount of excess kind of pre-funding is what we call it that they're willing to take on. But, they're only going to take so much pre-funding because it's negative carry if they're not able to put the money to work immediately. So, there's some upper threshold, like they're not going to take everything available to them all the time. But that is a conversation at the end of the syndication period for sure.
Got it. Okay, next question here is what redemption periods or secondary market options exist to trade once invested, if any?
Great question. So to date, we have facilitated secondary trades on an ad hoc basis when investors reach out. And, that has been an interesting exercise because we've, learned, the motivations for why people want to trade and tried to set ourselves up to accommodate that as quickly as we can by reaching out to existing holders if there's a seller that, do they want to take more based on, whether they got cut back in the most recent, syndication of that deal as an example, right? So we've been able to facilitate it kind of off the side of the desk. Now, this year we are making strides in actually launching a secondary market
Hmm.
for the Percent platform. So it's something that we've discussed on our own investor webinars that we do once a quarter. But it's going to be something that's very exciting and transformational for the platform because then it'll just be completely on platform. So if you have a portfolio and you're looking to sell a position or sell some of a position, you can put it in order and you'll see kind of the other, kind of indications of
Hmm.
buys and sells and kind of see where the market is clearing, if you will. So all of that is something that we want to be able to launch, hopefully, knock on wood. I don't want to put timelines in my product and engineering's team, but hopefully by the end of Q2.
That's awesome. Another question here. Can you explain more about what asset-based financing actually is, simple examples, and how it compares to other forms of private credit investing?
Mhm. Yeah, so to boil it down into two very simple examples. So a typical, commercial loan that a bank would offer, or even a private credit fund would offer, is really underwritten based on a company's cash flows. So you'll look at, historically how much has the company earned in revenue, and, 9 times out of 10, especially if it's a bank, how much have you actually earned in EBITDA or profit? And let's just say, you earned $1 million in EBITDA last year. And so that's kind of the cash flow that can go and service this debt. You typically, as a lender, will underwrite to that and say, hey, I'm willing to lend this company 4 or 5 times, that amount of profit that they earned last year, because that's risk that I'm willing to take and they can service the coupon pretty easily. And, it's a fair amount of leverage, and then I'm kind of making numbers up here, but not as well
Sure.
because 4 to 5 turns is probably kind of where the private credit market is. Investment grade bonds are probably like, 2 to 3, and then, something that's distressed is way further out. But typically speaking, it's a couple single digit turns of profit. So that's how, a corporate loan would work. Now, if the company is unprofitable, then, you got to think about, all right, how are they going to repay me, right? So what are the company's prospects? Do they have an equity fundraise taking place or something that where they want to delever and be able to repay the debt? Or, maybe they'll qualify for bank financing. So as a private credit lender, hey, I'm basically bridging them between now and when they're going to be able to take that SBA loan or whatever that is down the road that would be much cheaper than what I'm offering them. So, you think about the capital markets risk, right? Like, are they able to kind of refinance me based on, external fundraisings and not from their internal cash flows? So that's all commercial lending. And again, 9 out of 10 of that is usually for profitable companies. Unprofitable is a very specialized sector, which is venture debt and so forth. So that's very different from asset-based financing. So asset-based financing is saying, hey, what are the assets that are on your balance sheet? So do you have, and there's hard asset lending, and then there's, kind of financial assets. So hard assets are, equipment, machinery, whatever you have that's of value, right? That we could, as a lender, go in and technically repossess, go out and auction it, sell it, and then repay our loan because, that's our recourse in a default scenario. So in an asset-based deal, you're underwriting to the underlying assets. You're saying how much are these assets worth in the worst case scenario where I have to take them and sell them, am I able to repay myself in full? So whether those are, hard assets like equipment, or in our case, financial assets like a portfolio of loans, a portfolio of receivables, something that, they're in the business of originating. And so there's always going to be more loans that they're going to keep originating and keep replenishing. So that's the analysis that we perform is, all right, out of that portfolio of loans, what is the expectation that, that they're all going to perform, and how much cash flow can we expect to receive from those portfolio of loans, and not profitability, but portfolio of loans and the cash flows associated with them. And we make sure to ring fence those assets so no other lenders can lay claim on those cash flows, right? So UCC filings and making sure we have control over the bank account where the cash flow is coming in. So structuring it as like a true asset-based deal means that,
Hmm.
you are first in line to get repaid from those assets, whether you sell them or from the cash flows generated from them. So we do all of that work to make sure that, it's set up the right way.
Got it. Next question here. What's the breakdown of other investors on your platform look like into the standard deals? Are institutional investors, family offices, qualified purchasers, other larger investors using the platform in addition to retail? And just curious if retail is getting slightly less advantageous firms versus others who might be writing seven-digit checks like you mentioned. And if so, why are these deals seeking retail versus institutional capital?
Sure. So we don't, to clarify, we don't offer anything to retail. It has to be accredited retail. Everything is a Reg D note on the platform, and we solicit under 506(c), so we're able to advertise and so forth. So we have to verify accredited status whenever an investor signs up. Now, the institutional investors are comprised of family offices, RIAs, so advisors and large firms that are national in nature or local, but basically, kind of a team of underlying advisors are putting, deals into their underlying clients' portfolios. We also have interval funds and other type of funds that are in the private credit space that understand the value of lower middle market asset-based deals, and they're allocating into the deals. And then, there's probably a handful of corporates and kind of other type of players that are not individuals but would qualify as an institution. So, in terms of addressing, the question of how do you guys treat allocations and how do you syndicate in a fair way? So the the platform is able to take in orders from all the investors. So the question is, how do we allocate at the end of the day? And the way that we allocate is first, it goes to what we call blended notes. So blended notes is a product that we offer on our platform to all investors. There's a publicly syndicated version of it, and then there are like bespoke private versions of it. But the way you can think about it is it's basically like a separately managed account where you're investing in like a investment vehicle that has preferential treatment around allocations. So, and it's a portfolio of deals that it would invest in, and you're an investor in that vehicle. So that way you can get allocations, underlying allocations vis-a-vis that PBN without having any fear of getting cut out because it takes priority at the end of the syndication period. So you can participate in a publicly syndicated blended note, a PBN is what they're called, or you can reach out to our IR team and we can set you up with a bespoke blended note, a BBN, which is just basically saying, hey, what's your criteria? What kind of loans would you like to be put into this vehicle? Is it based on duration? Is it based on underlying deal type, geography, whatever it is? And then we'll just manage that portfolio on your behalf, and you'll also get preferential treatment around each syndication. And then it's everybody else. So everybody else kind of gets some level of allocation at the end of the syndication period. Granted, if you're writing seven-figure checks and the deal is only seven figures and not eight figures, if that order leaves the book because they can't get their full allocation and the deal falls apart, we have no choice but to prioritize those types of orders for the integrity of the order book. So we will do our best to kind of cut those investors back as best we can without jeopardizing the integrity of the deal, and then leave enough room for all of the other accredited investors that kind of bid regular way into the deal that aren't in any of those vehicles I mentioned before.
Another question here. I recently saw that the accredited investor definitions may have changed or the rules around it may have changed. Do you have any more clarity on what that looks like?
Yeah. I know that there was a no action letter that I think was kind of published or put out there maybe about 2 weeks ago or so. So I believe the no action letter stated something along the lines of if the investor's intent is to invest up to, I think, a couple $100,000 if you're an individual, or at least $1 million if you're an institution. then, no further verification is required. It's just you have to attest that it's your money, that you're not, borrowing the money or it's not someone else's money. But if you make that investment into a deal and you're attesting and kind of representing that it's your own money, then there is no further accreditation that's required,
Mm,
and you don't have to meet any of the other qualifications to be an accredited investor. So it's
mm.
really just based on the amount invested for the first time, which I think is
Interesting.
really interesting. I think it's a step in
Yeah,
probably the right direction for
absolutely.
for
Yeah.
the industry.
Next question here. How are you guys different from Yield Street?
So on our end, we are focused on is private credit. We don't do anything else other than private credit. So Yield Street, I know, focuses on a variety of different alternatives and asset classes within the alternative space. The other key differentiator is that, Percent is really structured, and we've been building towards a marketplace model that offers not only primary issuances, but soon to be secondary trading for those, positions that investors are holding. Percent is also a registered broker-dealer as its primary business model, whereas Yield Street, I believe, is an investment advisor. So
Mm.
slightly different in terms of how we're set up and kind of what our ultimate vision and goals are, is the way that I would kind of put it. But I'd say the biggest difference is that we are specialized in private credit, specifically asset-based private credit, and we have no intention to do anything else anytime soon.
Terrific. Well, that's all the questions that we have. If anyone else has any other questions, please drop them into the chat here. And last question for you, Prath. If
Sure.
folks are interested in utilizing the Percent platform, where should they go? What should they do?
Yeah, absolutely. So anybody can go to percent.com. They could read through the website. If they feel comfortable signing up, they can feel free to do so. It's a free account. You can then peruse through the open syndications. You can see all of our historical deals, how everything has performed over time. Everything is very transparent in terms of, past, present deal flow. And if you need any assistance, there's like a little chat box that you can reach out to, and somebody on our IR team would be more than happy to chat with you about any questions that you have. And if you want to schedule a call with one of our IR representatives, they're available as well. So, we're very customer centric, and we want to make sure that education is at the forefront of everything that we do. So if you don't find the answers that you're looking for on the website, I highly encourage you to reach out, because someone over here on our end is eager to talk to you about it.
One more question did come through, and thank you for
Sure.
that. And they are asking, uh, what is the ability to, one, how many syndications are there per year to have an opportunity to invest in? And
Mhm.
is there an ability to just automate how much I want to invest in the interest rate so that I never miss an investment opportunity?
Yes, yes, and yes. So we syndicate probably roughly 20 to 30 deals per month. So at any given time, there's probably somewhere in the neighborhood of 10 plus or minus deals that are currently live for syndication. So it's very easy to kind of deploy capital pretty quickly and then stay invested either in the same deals or rotate them into other deals and continue to stay diversified. So yeah, we'll probably do upwards of, 200 to 300 deals this year as a result.
Wow,
Yeah, it's pretty high frequent turnover type of, deal flow, as I mentioned before, because it's short duration, and we're adding so many more non-bank lenders every single month. So it's only going to go up from here.
that's
Um,
awesome.
and then in terms of, kind of being able to invest in an automated way, so that's exactly the bespoke blended note product I was mentioning before. So, if you just had something in mind in terms of an investment parameter, and you want to be able to only, have exposure to deals that have at least 13% coupons, that have less than 18-month durations, whatever it is, our team can help you design a box, design kind of an investment strategy, and then we would just simply execute on that and deploy your capital into those deals and keep you invested in those deals in a very white glove fashion.
Mm,
Granted, the minimum amount for, a bespoke blended note is a $500,000. If it's something less, we can entertain it, of course, and see if there's a path for you to be able to get that white glove treatment. And 9 times out of 10, we're happy to do it at lower amounts, but the goal though there is to really, keep this as user friendly as possible. We understand that not everybody has the time in the day to continuously reinvest and allocate and manage their portfolio in percent, especially if it's 10 to 15% of your overall portfolio, which is what we advocate. So we have these, kind of separately managed accounts, these, bespoke blended note structures that are designed to accommodate exactly something like that for a nominal fee.
Awesome. One more question, and then we'll wrap up here. What is the shortest duration? Is it 9 months, or do you have shorter term?
9 months is the current shortest term. I'd say 6, 7 years ago, we had deals that were actually as short as 1 month. The operational burden of rolling over something every single month, I think, was a bit
That's
tough,
pretty wild.
especially at that stage. Today, we could probably handle it, honestly, but it makes the most sense, even from the borrower's perspective, to have some term associated with the underlying deal so they can manage their business. And especially if they're out lending money, like they need they need some time horizon to be able to conduct their business. So 9 months is pretty much the shortest that is being offered these days, which is offered to an unlimited number of accredited investors. So those are the deals that have $500 minimums, which is the nice thing. And we do try to, keep a few of those syndicating at all times so that new investors can, hop on the platform, take it for a test drive, and put $500 to work and see how it all works.
I love that. Well, thank you everyone for attending, Prath. Thank you so much for your insights and your time. This was a wonderful, wonderful conversation. I think what you guys have built is really impressive, and you're building a trusted track record as well, which is so important in this space. For folks who are interested, I strongly suggest, go check out percent.com. It sounds like you could enter questions into the chat if we haven't gotten to them today or you didn't want to ask today. Feel free to go chat with their IR team. And hopefully you found this webinar helpful. Please reach out if you have suggestions about how we can make these even more informative, what you liked about them, so on and so forth, so we can continue to improve and provide more value to all of you. But yeah, thank you very, very much for your time. Prath, it's been a pleasure having you. Thanks so much.
It's been a pleasure, Chris. Thank you so much for having me.
Have a wonderful day, everyone, and we'll see you at the next one. Take care now.